If you know anything about the market, you should know that the market has both losses and gains. What you might not know is that losses can have more of an impact than gains on the value of your portfolio. Consider this purely hypothetical example. Let's imagine you have a portfolio of $100,000, but then you have a 25% gain. That's $25,000. So the value of your portfolio after 1 year is $125,000. Now let's say the next year the market's down. Let's say it's only down 20%. Well, what's 20% of $125,000? It's $25,000. So now you're back to $100,000. You were up 25% and then your portfolio experienced a 20% loss. Now you weren't down 25%, just 20%. But mathematically, it turns out that even though your down year was not as big as your up year, you ended up back to even. In fact, you could say that your average, a 25% gain minus a 20% loss, equals 5% divided by the 2 years. You've averaged plus 2.5% return, right? Well, you've actually averaged a positive rate of return. But how much did you earn? Nothing. You had a zero actual rate of return. That's because when it comes to investments, losses can have a more significant impact on the ending result than gains. If you experience a loss, in this case 20%, you need 25% just to get back to even. It doesn't matter in what order the gains and losses occur. A bigger gain is needed to offset a smaller loss. If you lose 33%, the percent required to return your portfolio to the same dollar is 50%. If you lose 50%, you have to gain 100% to get back to your starting point. Now, if you lose 60%, you have to gain 150% to get back to your starting point. And if you ever lose 75% of a stock or other investment, you have to gain 300% to recover your losses. For example, the broad stock market with the Standard & Poor's 500 lost 50% twice in recent history. Here's a hypothetical example. With a $100,000 portfolio at risk, many people lost $50,000. That was the 50% loss. Now, to make that back, there needs to be a 100% gain on that money of $50,000 to bring you back to square one. How much of your nest egg do you feel comfortable having at risk? A better question is, how much can you afford to lose? As you acquire more assets in life, losing becomes more and more powerful as the days to make it back become shorter. This is especially important when we retire. This is why the impact of losses and gains is very important for all of us as we go through life and retirement. Thank you.